So one day I posed a question to a group of friends that 20 years from now, the price of which of these is most likely going to be higher than their current market price, whether it's going to be Reliance, HDFC Bank, Infosys or Sensex. Now some of them said Infosys, some said Reliance, some said HDFC Bank, but very few answered Sensex. Now that was very interesting to hear because if we look back at the history of our stock market, it has been extremely hard to predict which stocks would outperform over the long period. Today's winners can be tomorrow's losers and today's zeros can become tomorrow's heroes. Why? Because a lot can change over time. Technology, consumer preferences, the company's management, new competition, government policies, and hundreds of other factors are there that can change the fate of any company. And that creates a big challenge for the long-term investors because if you cannot even predict which company is going to perform or outperform in the next 10 to 15 years, how can you invest in them? So the good news is that you don't have to make the leap of faith because there is a better way to invest, and that way is through index funds. So what is an index fund? Well, think of your exams in your school and college days, right? Because that always used to be a stressful time. You had to prepare, you have to revise, you have to do late night studies. I'm sure all of us have gone through that time. But what if you had an option of copying the answer sheet of the best student in the class, right? The smartest student in the class? Would you have ever bothered to study? I'm not sure about you, but I certainly would have not taken that much of stress, right? So an index fund works on the same principle. It is a type of a mutual fund whose only purpose is to copy an index. And what is an index? An index is a collection of the best performing companies in the market or a sector. Take for example Nifty, which is a collection of top 50 stocks in the Indian stock market. So a Nifty based index fund has a very simple job. Just keep buying the 50 stocks that are there in Nifty at any point of time, right? That's all they have to do. Just copy and paste, copy and paste. And every 6 months when Nifty decides that, okay, a bad performing company has to be kicked out and a better performing company has to be included, the fund manager of this index fund has to basically do the same. Sell the stocks that are going to be out of Nifty and buy the stocks that are going to be included in the Nifty, right? It's a very simple job that these guys have. Now contrast that with active mutual funds where it is the fund manager's job to pick the hidden gems, right? They have to look into the future and predict what the economic landscape would be like 10 years or 15 years from now, right? So the job of an active mutual fund manager is going to be much harder than that of an index fund manager. Now some of you might be thinking that, okay, isn't it better that we invest in an actively managed mutual fund because there we can generate a higher return rather than just blindly investing in an index? Well, the reality is, and I'm sure a lot of you would be surprised to know this, is that very few actively managed mutual funds are able to beat the index on a consistent basis, and this number is getting smaller and smaller every year. And if you look at the stats, it's actually very clear that 70 to 80% of actively managed funds have not been able to beat their benchmark index. And that's a lot, right? And not only that, for an actively managed mutual fund, we have to pay a very hefty fee to these fund managers, which is not the case with the index funds, right? So the question that we have to ask is that what is the point of paying such a high fee to these actively managed mutual fund managers when we can get better performance in index funds, that too at a much cheaper price? And that is exactly the reason why index funds are becoming so popular, not just in India, but around the world. So guys, let's just briefly talk about the advantages and disadvantages of investing in the index fund. So advantages are pretty simple. Number one, the fate of the index fund is not tied to any one company, right? So if the company is not performing, index will automatically rebalance and so will the fund. Number two, the fees that we pay for these mutual funds is extremely low as compared to an actively managed mutual fund. And number three, which is the most obvious fact, is that the returns generated from index funds tend to be higher as compared to actively managed mutual fund. But what are the disadvantages of investing in the index fund? Well, index funds have one big disadvantage, is that when the market is coming down, when the index is coming down, there is no downside protection in case of index funds. So what does that mean? Well, let's say the market is coming down. So for an actively managed mutual fund, the mutual fund manager has the flexibility to take the money out of the market, or they can hedge themselves, or they can rebalance their portfolio with more debt than equity, right? So there are different ways of managing the downside protection. But in case of an index fund, it is the mandate of an index fund manager just to copy the index and stay with it. Doesn't matter whether the index is going up or going down, right? So what does that mean? Well, that means that from a very short term perspective, index funds can become a little volatile as compared to actively managed mutual funds. So the $1 million question then comes that should you invest in index funds? And the answer is yes, you can and you should, provided that your holding period is longer, right? It has to be at least 5 years, 10 years or more, in which case you should consider investing in index funds, because all these short-term fluctuations will become irrelevant in the long run. And personally speaking, I have substantially invested a lot of money in index funds because I believe in the prospects of a country. I believe that Nifty, Sensex, no matter what happens from a short-term perspective, eventually the economy will go up and these indexes will go up, and hence the value of the index funds will also go up. So guys, this was a brief overview of index funds. There are some other aspects of index funds I was not able to cover in this video, but I hope that from this video you understood what index funds are and why they deserve consideration by every serious investor.